Vice President of CTC, Mr. Vijay Bhatt, learned faculty for today's session, Mr. Zubin Bilimoria, my fellow committee members Yogesh, Deepak, and Prashant. Welcome everyone for today. A very important topic on Schedule 3 and CARO, and we have very experienced faculty today who would guide us on the today's topic. Before proceeding further, I would request Vice President, Chamber of Tax Consultant, Vijay Bhai for his opening remarks.
Vijay, you have to unmute yourself.
Hello. Thank you, Tejas, for welcoming our speaker also and our members also. Welcome all the members of the Chamber of Tax Consultants and non-members also who are attending today's this very academic and timely required session on the lecture meeting on the important aspects and key learnings from Schedule 3 and CARO 2020 by none other than our learned faculty, Shri C.A. Zubin Bilimoria. About the chamber, those who are members, they already know. Those who are non-members, I must update that chamber is one of the very old organizations formed in 1926. Soon we'll be celebrating our centenary year and our events have already taken shape in that direction. Chamber is holding time to time various seminars through its various committees, especially accounting and auditing, indirect taxes, direct taxes, international taxation, plus it's coming up with monthly journal, students activities also like debate, essay competitions, moot courts and all. Looking to the activities and season of the work pressure, a chamber organizes time to time timely various subjects and its lecture meetings. And I must compliment Tejas and his team for this accounting and auditing committee that they are holding this, our term starts in the month of July. So July till now, this is our third meeting. Am I right, Tejas?
Yeah.
Third lecture meeting. First one being audit trail in the month of July, which was audit trail legal and practical aspects. Last week, we had a lecture meeting on the preparation of financial statements and applicability of accounting standards to non-corporate entities. So now it is time to prepare ourselves and update for Schedule 3 and CARO related matters. So I must compliment Tejas and his team for this thing. And I request non-members to become member and take benefit of all these lecture meetings at concessional rate or at sometimes zero rate. Without taking much of the time of yours, I once again welcome you all to this nice evening with the learned speaker, Shri Zubin Bilimoria. Over to you, Tejas, again.
Yeah. Thank you, Vijay Bhai, for your opening remarks and I think briefing about the committee and the CTC activities. So today is a very important topic which we had thought about Schedule 3. I think last 2 years experience also we wanted to share. Also, CTC had come out with a very important publication on CARO, which was almost like 800 to 1000 copies were sold. And I think Zubin Bhai was the architect of that publication. And I think he helped CTC publication and to a great extent. And I think it was one of the very first few publications which was even guiding the members about how to draft a particular clause. Having said that, I would also give a thanks to my committee members, Yogesh, Deepak, and Prashant, for I think coordinating today's event and keeping it on a very timely topic. So it would also help mid-size firm practitioners so that they fulfill their Schedule 3 and CARO obligation and meet the expectation of our regulator. With this, I would request Deepak to introduce our today's learned faculty, C.A. Zubin Bilimoria. Over to you, Deepak.
Thank you, Tejas Bhai, for the opportunity. Definitely, today's speaker doesn't need any introduction, but I am in a dilemma how to briefly introduce a speaker with such a big stature. So I'll try to do justice with it. So C.A. Zubin Bilimoria is FCA and he's also qualified company secretary. He's having 30 years of huge experience with Deloitte. Now he's proprietor of ZFB and Associates. He has worked into multiple sectors, state BFSI sector, mining, real estate, shipping, hotel, etc. He has 360-degree knowledge of Indian GAAP, US GAAP, Ind AS, tax audit, different areas where he has done his expertise. He's basically now corporate Ind AS consultant, and he's providing advisory services as well for that thing. He's independent director in Finolex Cables, Zoroastrian Cooperative Bank. He's treasurer. He was treasurer of DCS for 2022-23, and now joint secretary for the current year. He's also currently president of Lions Club of Bombay Host. He is regular speaker at various forums, state BCA, CTC, ICA, and he's also regular contributor to all the publications of this autonomous societies. He was technical reviewer and member of the panel FRRB of ICI. He was technical reviewer of Quality Review Board. So the list goes on and on, but due to the time constraint, I'll stop myself here. But it doesn't stop me from giving the detailed introduction of the speaker. And with this, I request Zubin Bhai to take.
Yeah. Yeah, Zubin Bhai.
Yes. Is my screen visible?
Yes.
Yes, sir. Yes, sir.
A very good evening to one and all, to the Vice President Vijay Bhai, and to the committee members Tejas, Yogesh, and Deepak and Prashant. It is nice to be in the midst of the CTC after some hibernation, if I may say so. So I will make it up. Now the topic which has been given, 2 hours time, Schedule 3 and CARO, for which for someone like me, even one day will not be enough. So don't get overawed by the number of slides, because number of slides are just to set the context and more for future reference. I request that the slides be circulated to whoever are the participants and to whoever else you deem appropriate. My focus really will be on the important practical aspects and the challenges which would be faced, and the challenges would be more from the MSME perspective, because see, the audit season for the listed companies is over. But what is now on us is for the non-listed entities, and some of them being SME sectors where there would be genuine practical challenges, which is what I have tried to put together. So that would be the tone really of my presentation. I will first, the other thing which is there is, as all of you know, there is a lot of overlapping between Schedule 3 and CARO. So certain points in detail I will discuss along with Schedule 3, and then certain points I will discuss when I take up CARO, rather than repeating some of the things. I am here now presuming that all the participants or majority of them would know the basic requirements, the basic clauses. So I will not focus really on those, though they may be put up on the screen, but I will concentrate more on the practical aspects, on the softer aspects, if I may say so. So with that, let us proceed. See, as Schedule 3, as you all know, is now about 2.5 years old. It is in 3 parts, which was already there earlier. Everybody is aware. See, most of the amendments are across all the 3 divisions. There are certain very specific amendments which are only applicable to Division 3 for NBFCs under Ind AS. Otherwise, Division 1 and Division 2, whether the company is following Indian GAAP or Ind AS IFRS, really not much of a difference except for minor changes in some requirements, which I will focus. Now, what drove these amendments to Schedule 2 is some of the amendments are in line with the accounting standards under Ind AS. The one common example being the disclosure of the nature and purpose of each reserve is a requirement under Ind AS that is being incorporated in Schedule 3. Some of the formats of the financial statements, the statement of changes in equity, for example, Then there is also the requirement of showing the effect of prior period errors and restatements by preparing an additional balance sheet. Then the most important aspect is to align the disclosures with CARO, because CARO requires a lot of things. Earlier, whatever requirements were there in CARO, most of them were not reflected in the financial statements. Now, quite a lot of the requirements are reflected in the financial statements, thereby making the management indirectly responsible. So there is a strong alignment now, and an integrated approach is being adopted. Now, these additional requirements, companies would have to gear up their MIS, their accounting softwares and all that. And also the auditors would have to increase the scope of their work, modify their audit programs and procedures, and also the controls over the generation of the data, the age-wise analysis, for example. A lot of it would require MIS support, audit software support, and also the internal controls will also have to be built in around all those things. Thus, audit practitioners, of course, would definitely have to refer to the guidance note. But I would also strongly urge people who are from the management side, or whom I call as the preparers of the financial statements, should also refer to the guidance note. And then amend their, not only the auditors should amend their audit programs, but the management should also tailor in their procedures, MIS requirements and software also to ensure that the necessary information is generated in a timely manner, with reasonable accuracy, to enable the auditors to do a seamless audit. And in many cases, see, the requirements may be such that you may have to also get involve yourself with the board of directors or with the management. And especially for the SME sector, the engagement with the top management, with the promoter, owner, shareholders is also important, because many of them may feel कि ये तो आपका काम है. So financial statements, auditors का काम है. That attitude has to change. You have to engage with them and tell them that what is the benefit for them. I will touch upon some of these aspects when I deal with specific clauses. So these are the four broad areas of the amendments. What is the reason really? What is the purpose of making these amendments under Schedule 3? See, the first thing is enhanced disclosures and greater emphasis or oversight on the governance aspects. So we will look at some of the amendments which achieve this objective. Then financial discipline and solvency. Then the third point is very important, and this is where major challenges will be faced. It is attempting to really see whether there is any money laundering, siphoning of funds, try and provide red flags or early warning signals. And the last is the residual minor changes or edits. I will not cover all the changes, all the amendments, but some of the main ones under each of these broad headings. See, the emphasis on governance, the first is on promoter shareholding, MSME disclosures, registration and satisfaction of charges, more than 2 layers of subsidiaries, scheme of arrangements, working capital funding, very important from the point of view of the banks who have lended money, revaluation related changes. A few of these changes I will discuss here. A few of the changes I will discuss when I discuss the corresponding requirements under CARO. So let us go to the first one, promoter shareholding. See, as all of you must be now aware, the shareholding of the promoters has now to be disclosed in a tabular form with the percentage of change, percentage of the total shares and the percentage change during the year. So this is the main requirement. So what is important? See, this looks very simple on the face of it, that what is the promoters ka shareholding is disclosed. Everybody knows who the promoters of the company are. But let us go one step further. Let us look at one thing is clear. You have to know who the promoter is. And for that, you have to refer to the definition under section 2, subsection 69. Okay. So the main thing which is there in that is, one is person who is named in the prospectus, identified in the annual return, and who has control over the affairs of the company as a shareholder, director, or otherwise. These are common. We all know. What I want to focus on is this clause C of section 2, subsection 69, which states that in accordance with whose advice, directions, or instructions the board of directors of the company is accustomed to act. See, this is a clause which is very important, and according to me, it is something which is neglected. See, there may be many times we normally associate with promoters through a shareholding, but there may be certain people who can call the shots even without holding a single share in the company, who can exercise a lot of moral influence on the company. There are a lot of practical examples which are there. Many times we have seen press reports also where certain people, certain individuals trying to impose themselves on the company even after they have actively retired. They are no longer on the board or as a shareholder. I would not like to publicly give any names, but those of you who have understood will get an idea. So what is important is that these people, if they are having some shares or whoever are the promoters, we need to identify them. See, because those are the people without whom really the board of directors cannot act. And if there is no such party, my advice to you as auditors is, and especially in the closely held companies, that in your letter of representation, you should obtain a specific representation that in the view of the management and the board of directors, there is no person who is a promoter in terms of section 269 subsection C. Now the classes of companies have to be determined as per the legal form rather than as per the substance. Many times promoters, subsidiaries and all that, we will look at that aspect later. They go as for our purposes, especially companies adopting Ind AS. We may not necessarily go as per the accounting standards, but we have to go as per the Companies Act, which is the legal form, which is what we have to adopt. We will be coming across these situations in a lot of other clauses later on, which we will see. You have to also be cognizant of one thing for the listed companies, that the disclosures have to be consistent with what we disclose as per the LODR guideline, SEBI LODR guidelines. A next clause again, which looks simple, just what is there in registration and satisfaction of charges. But there also, there are a lot of important provisions under the Companies Act and the rules which you should be aware that there may be delays. Sometimes the delays may be condoned. Sometimes extension of time is also provided. So you have to be aware, because the simple requirement is that for registration of charges, whether there has been a delay in the registration and satisfaction of charges, that is the basic factual statement which we need to make. So you need to be familiar with the provisions of 77(1) of the Companies Act, section 78 and 87, and the related rules. And even charges on intangible assets, many times in the service companies, on your intellectual property rights, patents and all, also there may be charges which may be created. So those also need to be kept in mind. So there is, as I said, maximum time limit up to 300 days where an application can be made to the RRCs. Sometimes even if a charge is not registered within 300 days, approval for a rectification under section 87 is also permitted. So you have to be aware of all these provisions. Reasons for the rectification so that it does not prejudicially impact the shareholders. Then these are the various forms which are required to be filled. So those you need to be aware, because that is your basic evidence of whether the charges have been registered or not. Okay. Now, satisfaction of charges. Now, many times what may happen is that the company may fail. So the person in whose favor the charge is created, the person who is lending you the money, he may also inform the RRC, apply to the RRC, and then there are certain formalities which have to be complied with within certain number of days. 14 days and a maximum additional time limit of 270 days. So these are also certain provisions you need to be aware. Satisfaction of charges also. Normally within a period of 14 days, you need to 30 days. And then on receipt of the intimation, the RRC shall send a notice to the charge holder as to why satisfaction should not be recorded. If no intimation is received, the RRC can also proceed on his own. So these are all the provisions which I have tried to summarize for satisfaction of charges, which you need to be aware. So another source of information is the secretarial audit report. So you need to ensure that all the facts and circumstances are appropriately disclosed, where the charges are not registered, where the borrowings are there, new borrowings have been taken, or where there is a renewal, modification of the terms, or where there is a repayment. So all these trigger points you need to keep in mind. The next thing is compliance with approved scheme of arrangement. See, anyway, even under the existing accounting standard, there was always a requirement that the accounting treatment under a scheme of arrangement has to now be in accordance with the accounting standard. See, earlier companies used to frame their accounting, the schemes of arrangements, the accounting treatment the way they wanted. With the High Court approval was taken, NCLT approval, now under Ind AS and even under SEBI guidelines, you need to obtain a certificate from the auditor that the scheme is in arrangement with the relevant accounting standards. And deviation has to be explained. So we need to ensure that AS 14 and Ind AS 103 requirements are complied with. You need to ensure that the NTLT order is reviewed. Now, suppose a situation where the accounting treatment is different, then the disclosure has to be made, and that disclosure prevails because it is law, because if it is approved by the NCLT or the High Court. So that such situations will now be very rare and should normally not occur. Then working capital funding. See, now here, these are the clause. This clause is relevant from the point of view of Schedule 3 disclosure requirements, where the requirement is that where you have borrowings from banks or financial institutions, whether the quarterly statements have been filed on time and they are in agreement with the books of accounts. And as if not, a reconciliation, summary of the reconciliation and the reasons. Now, this has to be considered for both sanctioned borrowings, fund and unfazed limit. So it is not only that when the disbursement is made, but even if a sanction is there. Disclosures need to be made even for facilities against the security of the current assets of group companies. It is not only against the security of your own assets, but against the security of the assets of your group companies also. So many times one company may not have, so it may give the security of its group companies. So those also are covered. The corresponding CARO requirements, which we'll see, are a little more specific, where reporting is only if it is more than 5 crores, whereas here you have to report in all cases. So now here there are a lot of practical challenges, because if a company has multiple locations and the security is against inventory at specific locations, or it may be at inventory of specific plants, so then that has to be considered. Then if it is against the overall security of all the current assets, all the debtors and all the inventory at all the locations, it is important that none of these locations get missed out. Then see, there are specific challenges here for MSMEs. MSMEs may not necessarily have updated books of accounts at the end of every quarter. They may not be regular in updating their accounting records. So hopefully now over this last 1 or 2 years, this will hopefully have led to better discipline. So this is really a win-win situation, both for the company, for the lenders, the banks, and also for us and for all of you who are there as auditors also. So MSME challenges are there. So these are some of the challenges which are very important. These would also be relevant when we consider the reporting under CARO, which we will discuss later on. The same thing will apply really. Now the next, see some of these other clauses which I saw, which I've covered. 2 layers of subsidiaries, that is a straightforward requirement. Revaluation, MSME disclosures on the face of the balance sheet, nothing is there. Revaluation I will cover in detail when I am covering CARO. So now under the next category, under the financial discipline and solvency. Ratios. Now all of you know that all the companies now have to disclose certain ratios, and where variations are more than 25%. And you have to also give the definition of what is gone into the numerator and what has gone into the denominator, and that has to be tallied with the specific line items in the financial statements. Many times there are a lot of ratios which may be disclosed in the MD&A, director's report and other places. We need to ensure consistency, because that is also a requirement of the standard of auditing SA 720. See, SEBI LODR also, as I said, requires certain disclosures. So we have to ensure consistency. See, now there are certain ratios which are also key ratios which may be disclosed in the MD&A, but which for some reason are not part of Schedule 3, like your gross margin, operating margin, EBITDA margin. These are the ratios which are tracked by analysts, but unfortunately, these are not there. Sales to material consumption as a percentage of sales, employee cost, advertisement. These are also important ratios, but some of these, for whatever reasons, don't need a disclosure. See, here it is again important that for NBFCs, so companies which follow under Division 3, which are NBFCs, have to prepare financial statements under Ind AS. They have to also disclose the capital adequacy ratio, CRAR, capital risk assets ratio, liquidity coverage ratio also. Now, these are the ratios in any case where in the financial statements you need to give in terms of the RBI guidelines. Now, here under RBI guidelines, it is very clear that this information has to be as per the regulatory requirements and prudential norms. So all of it may not necessarily tally with the financial statements. So this is also one important aspect you need to keep in mind. Now you need to be aware of what are the minimum capital adequacy requirements also which are there, which different categories and classes of NBFCs have to. So a person who is lending against gold jewelry, has to have a minimum tier 1 capital of 12%. In case of microfinance institutions, the total of tier 1 and tier 2 capital should not exceed 100%. So these are some of the regulatory requirements which you need to be aware. Liquidity coverage ratio is also an important ratio for NBFCs. It is nothing but the ratio of the high quality liquid assets to the net cash outflow over the next 30 days. How liquid are you to meet your obligations in the next 30 days? It is prescribed for certain categories of NBFCs, your deposit taking NBFCs, non-deposit taking NBFCs with an asset size of 10,000 crores. Systemically important. And non-deposits, it's on systemically important with an asset size of above or less than 10,000 crores. Now, these are the ratios which are required to be liquidity coverage ratio at a minimum level, which is required to be maintained in a phased manner from December 20 onwards. This is a very important ratio. The working has to be seen very carefully. Now, this is again a very important requirement of aging of trade receivables. Here, I think the outstanding is from the due date of payment, not from the date of the invoice, but from the due date of payment. So it requires tracking of the due dates of payments under various buckets. Earlier, we are all used to more than 6 months and less than 6 months. Now that is gone. Much more granular information is required. As auditors in many companies, we may even be getting that information, asking for that information also from the company. Just 1 minute, I'll just. So we may be asking for that information from the company. But now, what is important is that earlier the information which was more as part of our working papers is now coming out in public domain. So the skeletons in the cupboard of the company, so to say, are now out. Now here the other thing is you have to give the disclosure separately for undisputed and disputed dues. So that also now you need to be very clear about the distinction between undisputed and disputed. Then similar disclosures have to be given when no due date of payment has been specified. Many times there is no due date. So you have to distinctly also give those. Unbilled dues have to be also disclosed separately. Now, what is an unbilled due? Where the entity has an unconditional right to the consideration before it invoices its customers, because the entity has satisfied its performance obligations but has not raised the invoice. So that is also the information which is required to be disclosed. I think all of you would have seen over the last 1 or 2 years. So that, as I said, now there is greater transparency. The skeletons are out of the cupboard. It gives an indicator of the health of the trade receivables portfolio. Now, as auditors, you should use this disclosure as a starting point to ask probing or relevant questions to the management in case of any abnormalities or deviations from industry trends. You need to compare information across companies within industries and all that. Lot of red flags can come out. There may be overbooking of sales invoices. There could be early recognition of revenues. There could be fake or non-existing sales to inflate sales, and trade balances get reflected as old dues. And then after 3 years, they just write it off. So many times that also happens. Under invoicing of exports and receiving excess amount in undisclosed foreign accounts or diversion or round tripping. So all these things can come up through as red flags through this analysis. Very important. You need to be aware and alert. Need to exhibit professional skepticism. Provisioning has to be now made appropriately. Board of directors are responsible. MIS systems need to be geared up. You need to scrutinize the legal correspondence. Consult the legal counsel wherever required for major dues. So you need to be aware of all those matters. So just 1 minute on this. Okay. Now, here, this is one of the few clauses where there is a slight distinction, subtle difference for Ind AS companies. Because for Ind AS companies, as all of you would be aware, the outstandings have to be disclosed for not only the normal debtors, but you have to distinguish between the cases where there is a significant increase in the credit risk and those which are credit impaired. The aging buckets remain the same, because for expected credit loss provisioning, what is important is whether it is credit impaired, whether there is a significant increase in the credit risk. Those are the two starting trigger points which are there. So you have to be familiar with that part. So here, the familiarity with the Ind AS principles is important. See, there is normally a rebuttable presumption that the credit risk is considered to have increased significantly if the contractual payments are more than 30 days past due. But that is not the only criteria. There could be cases more than 30 days where there may not be a significant increase in the credit risk. There could also be cases with less than 30 days overdues where there will still be an increase in the credit risk. So you have to use your judgment. See, what are the indicative changes are given under 109, where there may be an increase in the credit risk, actual or expected changes in the credit rating, operating results, there is a deterioration or a change. There may be decrease in the value of the security or collateral. So these are all indicators. Now, credit impaired financial asset also is normally there is a financial difficulty, there is a breach of a contract or a covenant. So there is a financial difficulty. And there also there is a rebuttable presumption that anything more than 90 days, which is normally for NBFCs a trigger point for provisioning, also for the other companies also. There is a reference to the IBC. There is a deep discount, the purchase or origination of a financial asset at a deep discount. So there could be various factors. These are all things which need to be kept in mind. Trade payables, also age analysis is important. Earlier, trade payables the aging was never disclosed. You may get for your audit working papers, you may obtain the information, but otherwise it was not really there as part of the financial statement disclosures. Now here again, you have to identify your not only undisputed and disputed, but also what is from MSMEs and others in the age buckets as indicated here. Unbilled dues have to be also disclosed separately. Unbilled dues include accruals, your normal provision for expenses which you make. Those are unbilled dues, have to be disclosed separately, but not the provisions which involve significant degree of estimation covered under AS 29 and Ind AS 37. Disputed dues also, you have to consider the definition under the IBC code. That will also be an important factor. MSMED disclosures have to be separately given. Now, even here for the trade payables, where there is, you have to refer to the purchase order to see what is the credit period which has been allowed. And then after that, you have to take it from that date. So here again, Similar considerations will apply as is there for debtors, like greater transparency, improving quality of disclosures. Here also, old credit balances, there may be due to various reasons. So you need to be aware. Undue delay, wrong recording of vendor invoices, recording payments against a wrong vendor, fake purchases, delay in payments due to oversight. Many times those also may be there. Over invoicing of imports, receiving excess amount in undisclosed foreign account by diversion. So all the mirror impact of what we saw for receivables is also applicable for payables. See, there may be even fund diversion may also come to light. Here again, board of directors and MIS systems, detailed scrutiny of correspondence with vendors, confirmation procedures need to be strengthened. All the same things which is there for debtors would also apply to the creditors also. Payables. This is another very, very important disclosure. Something very unique was not there earlier. CWIP balances. Now that has suddenly come under limelight. Not only CWIP, but even intangible assets under development for service industries. These are very important things. Outstanding for following periods, for projects which are in progress and also projects suspended. So now information has to be maintained project-wise. Very granular data is expected to be maintained by the companies for how long a project is pending and which are also temporarily suspended. Then for CWIP balances where completion is overdue, this is again a very important thing. How do you determine whether a project is overdue or where the original cost has exceeded the budgeted cost? So timeline for completion, less than 1 year, 1 to 2 years, more than 3 years, again like earlier. So this is again another area where there is a lot of judgment. So what are the practical challenges? Originally, there was no such requirement. There will be a lot of qualitative analysis. It will give an indication of extent of old balances lying. It will give clues of what you need to impair. Reasons for variations could be on account of various factors. Stuck up or delayed, whether due to lack of funding, whether there is some regulatory hurdle. Greenfield projects may many times take a long period. Sometimes projects may be pending because of genuine reasons. Abandoned projects which are no longer feasible because of lack of demand or new technologies. So then whether they should be written off or impaired. Many times what may happen is there may be a temporary suspension which may be necessary as part of the process for getting an asset ready for its intended use. This is not considered as temporary suspension. This is the similar principle under the borrowing cost standard. So you need to distinguish between what amounts to suspension of activities and suspension of projects. Activities may be suspended, but the project may not be suspended. So those are okay. So you need to be aware of this. Then money laundering early signals. Struck off companies, Benami transactions, immovable property not held in the company name. We all have seen these are the requirements even under CARO, willful defaulter, borrowings and lendings, cryptocurrencies and assets. Here, most of the other questions, struck off companies, see, normally this is where there is a challenge. Many companies are now relying on software vendors to identify such companies where they provide the dump and then companies get identified. Dynamic transactions I'll discuss in detail with CARO. Also immovable properties and willful defaulters I'll discuss with you when I am dealing with CARO. Loans and borrowed funds. Also, while I discuss the requirements under CARO for both deposits and borrowings, I will just very briefly touch upon certain aspects of cryptocurrencies and assets. So what are the disclosure requirements? Profit or loss on transactions involved in cryptocurrency or virtual currency, and deposits or advances from any person for the purposes of trading or investing in cryptocurrency. So these are the disclosures which are required. See now, cryptocurrencies, one thing you have to remember, currently there is no specific accounting guidance. There is no specific accounting standard dealing with cryptocurrencies, whether it is the recognition, measurement, valuation. Ideally, Schedule 3 or the Companies Act or somewhere the manner of accounting should have been given. However, we may have to adopt some accounting. Different companies may follow different basis. See, here I have just tried to identify certain standards where some guidance may be provided. In AS 7, whether it is considered as cash or cash equivalent, my answer is no. 109 is whether it is in the nature of a financial asset. That also there is a doubt. Whether it is an intangible asset, whether it is an inventory. Then what are the subsequent balance sheet events? Fair valuation requirements may also be there. So these are some of the standards which indirectly touch upon the accounting. I am not getting into the details. I mean, there may be some literature which is available. If you can do some Google search, you will find reference to these standards. See, basically, there is a blockchain technology. That is what we use. It is a blockchain. There is a digital ledger, what we call it. Now, there was at some point of time, 2-3 years back, there was some RBI had issued some circular completely banning cryptocurrencies. The Supreme Court then took a view that maybe you cannot entirely ban them. Finance Minister also now, and even the RBI is also now talking about its own virtual digital currency. So now whether all those things, so there is now gradually an acceptance of trying to legally recognize cryptocurrencies, digital currencies. So these are the things which will emerge over a period of time. I'm sure there will be a lot of other developments over the next couple of years in this area. Whether crypto digital currencies would also come within the definition of these crypto assets, again, there is no clarity. So these are all some practical issues. Apart from these, there are some of these minor edits or changes which are there. So which essentially summarizes the major changes in Schedule 3 requirements. Section 8 companies also now, these foundations, a lot of companies for CSR purposes, foundations, the grants which they get, donations. So that will also all be part of operating income now. Lease liabilities, change in the format of statement of changes in equities, NBFCs, I said disclosure of ratios. Change in the terminology, so even small things. So with this, I have tried to cover the Schedule 3 changes, and especially the ones which are the common ones, and where especially the aging related disclosures, where there are a lot of practical challenges which are there. If there are any questions, I can answer them at this point of time. Are there any questions?
Participants are requested to share their questions in Q&A section. And in case somebody wants to ask the question, it can raise the person can raise hand.
Any practical challenges which any of you have faced, any doubts? More than 100 participants, and very surprising. Either nobody has faced any problems, or the other option is nobody has understood and it has gone above the head.
Thank you. Third option, Zubin sir. Everyone has understood really well.
Acha. Let's hope so. Here's some question, Mr. Atul Somani.
I
Yes,
am
please.
allowed Atul Somani to speak.
Yes.
सर आवाज आ रही है
Haji, Haji.
सर in the first year of the company subscription to memorandum and association my company secretary say you show in schedule related to share capital as a opening balance. How can I show this subscription to memorandum as a opening balance?
I didn't follow subscription to memorandum as an opening balance means. No,
This is
first-
the first year of the company. And
there
I
is
have
no
to
question
show
of opening. There
the
is no
share
question
issue
of
during
opening
the
balance.
year.
I agree. I agree. He is wrong. It is not an opening balance.
Okay,
Is
so
it
I
the
have
first?
to.
Wait 1 minute. No, it is the first year of Schedule 3 implementation or first year of the company.
No, this is the first year of the company and as
Then
per
there is no
schedule
question
3.
of opening balance.
Haji?
There is no question of opening balance in the first year.
Okay, but in ROC forms, when we file the details of the company, it is required that how much share application money received during the year and share issued. My
Yes.
company secretary say ki there is no share application money received during the year. How can I show share issued?
No. When you subscribe to the memorandum,
Yeah,
see, that is means you have subscribed to the shares. You are a shareholder. You are the initial shareholder. So it has to be
correct.
disclosed as part of share capital.
Yeah.
That
So
is my
now,
understanding.
okay.
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 Yes.
Thank you.
Thank you. Yeah. I think somebody has put up questions in the Q&A. Somebody, can they read, please? What is there?
Yes. Revenue sharing done by builder, then at last and on 31st March 2023, revenue sharing is 30 lakhs, but same invoice will be, same invoice will be,
Revenue sharing, 1 minute, let me read. I can also read. Revenue sharing done by builder, then last and 20 revenue sharing of 30 lakhs, but some invoice will be raised and then amount to be reported. Aging of debtors for non-billing since. See, this will be, you will have to see whether this is like an unbilled revenue. This may come under unbilled revenue. Okay. This is like unbilled revenue. You may have been entitled to certain amount, but you have not raised the bill. So that is unbilled revenue. Then can you please give some knowledge on financial instrument disclosures?
it's a general question.
That is a very general question. I think, I'll need a full session to deal with financial instrument disclosures. Any specific point on financial instruments? I will cover some of it when I cover CARO in terms of compound financial instruments and all that. I will touch upon some of those points for that. Any other?
No.
Okay.
Any other questions?
So I'll be just back in half a minute. I'll just come back. Just please be on. There is some.
We will request the participants to put their queries in the Q&A box and not in the chat.
Okay, we will continue now. We will proceed to discussing on CARO. In CARO, I intend to cover only the changes under the following broad headings: PPE and intangible assets, inventories and other current assets. The main thing I will be focusing on is on investments, on deposits, and on some of the requirements for NBFCs and frauds and reporting on financial position. CSR and resignation of statutory auditors, maybe some part. So these are the things which I will cover. Quite a lot of these are again areas where there are Schedule 3 changes, which have already been covered upon. Some of the things where disclosures under Schedule 3 are required and reporting under CARO. So I will cover it under detail, like unrecorded transactions and things like willful defaulters reporting in those aspects. So let us move ahead. See, now, as all of you know, CARO is now nearly 50 years old. It started in 75 as a Mao CARO, where it was only earlier for manufacturing companies. Now it is covering a broader spectrum of companies. Earlier, there were certain exemptions. Now the extent of exemptions are very limited. Now, what is the reason now really for CARO? See, CARO is broadly in the form or in the nature of a proprietary audit, where certain proprietary aspects of companies have to be considered. Now, there have been a lot of reports of reduced trust of investors. Regulators are also not very happy. There are a lot of frauds. There are non-compliances, which have all led to collapse of businesses. So because of all these, then the lenders, the bankers also need some support. So a lot of the tax authorities need a lot of support. RBI needs a lot of support to see whether, any willful defaulters are there. So all these gaps are now intended to be breached by CARO reporting requirements. See, now there are certain things where there are very explicit assertions on specific matters. In many cases, as I told you, changes have been made under the financial statements in Schedule 3. Now, many times, many aspects are required to be reported and disclosed, even if they are not material. For example, frauds. So they take into account the changing needs of the business and other stakeholders, including bankers and other lenders. Okay. Now, what is the general audit approach? This is just for all of you who are auditors. You need to reassess your audit plan and your audit strategy. You need to seek more information. You need to validate the information which is provided. The only advantage is that quite a lot of the information is now as part of the notes to accounts. So it automatically gets disclosed and validated by the management. You have to also provide a lot of judgmental areas, a lot of comments and judgment on specific items based on verification. We will be seeing all or some of those. See here again, like for Schedule 3, the MIS may need to be suitably modified to capture all the relevant information required for reporting. We will see in which specific areas these challenges could be there. Now, normally it is expected that before you start the audit, you submit a checklist or a questionnaire. That has been covered in it is also a suggestion through the CARO 2020 guidance note. And then you have to obtain a lot of things where there is a representation. One thing you have to remember is that you should avoid using the terminology as represented by the management. Representation from the management is only an additional support. It does not relieve you of performing your procedures, the normal audit procedures, by making inquiries and all that, obtaining evidences wherever required. So now let us cover PP. Now another thing what I would like to just bring upon is that in a lot of the reporting clauses, the auditors are expected to be familiar with a lot of legal and statutory provisions. I have touched upon some of those statutory provisions, but I have not discussed in detail except in a couple of places where it is very important. My focus will be more on the practical issues and challenges. The scope also for each of the clauses, I will just touch upon where are the main changes are there, where there are enhanced disclosures or where there are purely and entirely new clauses. So sub-clauses which have been modified and additional sub-clauses introduced. Terminology changed. No reporting is now required for non-availability of title deeds of lease property. In case title deeds of immovable properties are not held, you have to now give specific details. Specific details as to in whose name the property is, whether it is in the name of a promoter or a related party, and what is the reason for not transferring it in your name. These are the three broad disclosures which are required to be given. Earlier, you are only required to give the value of the title deeds not in the name. Now that has been modified or extended to cover in whose name, whether promoters, related parties are there, and whether there is any reason and whether there are any disputes. Now, additional sub-clauses, intangible assets also you have to provide reporting. Then revaluation of PPE and intangible assets to state whether company has revalued and whether the revaluation is greater than 10%. Benami property, this is a very important clause. I will touch upon that in some bit of detail later on, whether appropriate disclosures have been made for Benami properties. So now let us go into the, see, these are the statutory provisions which you need to be aware. Promoter, we saw the definition under section 2, subsection 69. This is required everywhere, even for your loans, investments and all, whether in the name of promoters. So you need to be familiar with the definition of promoters. Very important. So if not for equity share, even for these, because especially 2 section 62 subsection 69 subsection C, whether in accordance with whose directions or instructions anybody in the board of directors are expected to act. Relative definition also, registered valuers, Benami property transactions also. Now, what are the practical issues and challenges? Many times we come across cases where the properties are jointly owned, where the title deeds are not held in the name. So here you need to give the extent of the company's share. Many times a company may have changed its name, but the reporting may not have been updated by the statutory authorities. Registration may not be in the new name. So that factual disclosure. Your identification of Benami properties. See, Benami properties may pose challenges because especially if they are not reflected in the books. More often than not, they will be not reflected in the books. So what do you do? See, you have to follow the normal procedures like review the minutes, scrutinize legal expenses if any payments have been made to any advisor or any such thing. Risk management committee, secretarial records, list of pending litigations. Many times you may have to obtain an independent confirmation from legal counsel. Now the reporting under this clause is only in cases where proceedings are initiated or pending against the company as the Benamidar. Who is a Benamidar, we will cover in the next slide. If a company is only the beneficial owner, you are not required. So here, let us just refer to the key provisions, key legal provisions in the subsequent slide. See, a Benami property is a property which is the subject matter of a Benami transaction. So you need to understand what is a Benami transaction. See, it is a transaction or an arrangement where a property is transferred to or it is held by the person, and the considerations for such property has been provided or paid by another person. So any transactions between your group companies, related parties, where transferred to in the name of one person, but payment made by another person. The property is held for the immediate or future benefit, direct or indirect, of the person who has provided the consideration, except if it is within a Hindu undivided family or for the family members or in a fiduciary capacity or by a depository participant. These are the exceptions. Otherwise, if it is a property which is held for the immediate or future benefit, direct or indirect, of any person who has provided the consideration. So if it is somebody else has made the payment, if it is other than the katta of an HUF or for your family member, you can make the payment for your wife or for your relatives, some of them. Or you can be in a fiduciary capacity where you are a trustee or you are a depository participant or an agent. So that is okay. Spouse or child, that is also as an exception. A transaction or arrangement is made in respect of a property carried out in a fictitious name. Or sometimes when a person is not aware that there is a property which is there in his name. Owner is not aware or denies knowledge of such ownership. Name lending or something of that sort. Transaction or arrangement in respect of a property where the person providing the consideration is not traceable or is fictitious. See, here for the removal of doubts, it is declared that Benami transactions shall not include any transaction involving the possession of a property taken under Section 53A of the Transfer of Property Act. So that unless some of the legal requirements are there, which may be satisfied, so then you have to be familiar with these legal requirements. Now, who is a Benamidar? Benamidar means a person or a fictitious person in whose name a Benami property has been transferred or held, and includes the person who lends its name. So whether a company is really a Benamidar, it is a holder of a property for which it has not paid any consideration or the consideration has been paid by someone else. This will normally be for subsidiary companies, group companies or other related parties, intermediaries. Initiating officer means an assistant commissioner or a deputy, that is okay. And property means any assets of any kind. It includes movable or immovable properties, tangible or intangible, corporeal or incorporeal, and includes any right or interest or legal documents or instruments evidencing title or interest in the property. So main thing is what is a Benami transaction, and if you are a Benamidar. If you are a beneficial owner, then you are not required. Then the next thing is intangible assets, compilation of data. See, many times companies have not been maintaining records for intangible assets. They may not have a proper inventory. So you have to reconstruct the data. Now that may have been a challenge in the first year. Now hopefully this may have been resolved. Especially, see, many times for the licenses and internal for this research-oriented companies, the IPRs which they are generated. So that I think based on internal SOPs, the development rights which are there, the nature of documentary evidence which supports it, all this may not be always clear. Copyright, trademarks, licensing arrangements under pharma, aviation, telecom, whether the legal requirements are complied with. You have to be aware of the laws dealing with registration of immovable properties. There may be some timeline within which you need to do that. So because of which there may be a delay in transferring to the name of the company. Business combinations under 103 Ind AS. As you may be aware, there are a lot of identified intangible assets which may be acquired as part of the transactions. These need to be also captured into the accounting records and need to be part of the fixed assets register. Many times in such cases, even for merged entities, you may take time to transfer into the name. If an amalgamation has happened, all the properties may take some time to get transferred in the name. So then factual disclosures have to be made. Revaluation. One thing is clear only to a company who adopts the revaluation model. If you do a fair value on first time adoption to transition to Ind AS, that is not a revaluation. That is your deemed cost. Similarly, ROU asset also, right to use asset. Any revaluation changes due to impairment, foreign exchange rates and all will not require reporting. Impairment also is not covered. It is only revaluation. And revaluation involves two scenarios. The valuation may be done by an external valuer. So that fact has to be indicated. And whether he is a registered valuer under Rule 2 of the valuation rules. In such cases, you need to ensure that the 113 principles of fair valuation are followed even for Indian GAAP companies. Since there is no fair value standard under Indian GAAP, you can refer to Ind AS. So audit evidence you may rely as if the fair valuer is like a management expert. The external valuer is like a management expert. So SA 500 requirements of audit evidence have to be kept in mind. If it is an internal valuation which is done, see, nowhere does it state that it has to mandatorily be done. It may be done internally. If it is internally done, there has to be a greater degree of professional skepticism. You still need to keep in mind the requirements of AS 113. You have to also keep in mind the requirements of SA 540, accounting of estimates, including fair value estimates. And you may sometimes, the auditor may seek the assistance of their own valuation expert. So in that case, the requirements of SA 620 using the work of an auditor's expert need to be kept in mind. So these are some of the points for inventories, for fixed assets, including intangible assets, the practical challenges. Now, inventories, basically the scope, there is a modified subclause and an additional subclause. Modified subclause is whether in the opinion of the auditor, the coverage and procedure is appropriate. So here also a lot of proprietary aspects have to be considered. Not only whether the valuation is done, but whether it is done in a proper manner. And whether there are discrepancies in excess of 10% and have they been properly dealt with in the books of accounts. So these are two additional requirements. And then I told you when we looked at Schedule 3, they said that if it is sanctioned working capital limits, there was no limit. Whereas here there is a limit that limits in excess of 5 crores, whether the quarterly returns have been filed are in agreement with the books of accounts. So this is what I have discussed with the Schedule 3 changes. The only difference is that CARO reporting is only required if it is in excess of 5 crores sanctioned limits. Otherwise, all the other requirements are same what I discussed during Schedule 3. So the practical issues, see, for the appropriateness of the procedure for physical verification, you have to take into account the procedure over the control of the movement of inventory, whether proper internal controls are there, whether whenever you go for a physical verification, whether, the proper cutoff procedures are followed. It is important to comment on specific areas where the procedures are not adequate. See, normally we tend to report that procedures are generally adequate. This sort of reporting now has to stop. We have to specify which are the areas where we feel that the procedures are not adequate rather than commenting that the procedures are generally adequate. Now, if the inventory is under the custody of a third party, bonded warehouse, job worker, there the procedures undertaken by the management to evaluate the existence and condition of the inventory. Then if the auditor finds that the inventory is with the third party for a period longer than that, he has to obtain the reasons for the same. Especially here, the condition of the inventory also, if it is in the custody and control of a third party. Many times there may be specialized inventory where inventory count is not based on physical verification, but it may be based on some approximation. Mining industry, oil and gas, petroleum reserves and all that. So many times I think coal, all those things, I mean, you may have to take the help of engineers or experts. So that also needs to be seen whether that adequacy is there, whether they are following the proper procedures, how the conversion of the measurements and all that is done. These are things which have to be kept in mind. Now, when you say appropriate coverage, what are the factors to be considered to determine whether coverage is appropriate? The nature, size, materiality, location, whether it is feasible to conduct a physical verification. See, many times there may be certain inventory which may be lying in areas which are not accessible. There may be some warehouses and some locations which may be lying in areas, I mean, because of weather conditions, very difficult to access. Or it may be terrorist infected areas in some Chhattisgarh and all those areas where Maoists are there. So significant judgment will have to be required in all these cases. Classification of inventory. See, inventory classification is important. ABC analysis is the main thing which has to be kept in mind. Slow-moving inventories, whether they are properly identified, obsolete or damaged inventories, whether they are properly identified. And also, whether the A and B items are covered, C items, all of them, even if they are not covered, it may not impact. So these are the factors which have to be kept in mind. Periodicity of the verification. Again, that would be a function of the ABC classification. But there has to be a proper systematic plan which has to be designed by the management. Now, if there are discrepancies more than 10%, what could be the causes of the discrepancies? There may be incorrect data entry, issues not recorded, stocks could be misplaced, supplier frauds may be there, free samples may be given, there may be weight loss or gain due to passage of time, theft or natural calamities. So this could be the reason for the differences. So some of them, it is important that some of these are properly adjusted in the books, or otherwise, so we have to ensure that they are reconciled. What are the reasons for that? So these are some of the factors which you need to keep in mind while dealing with discrepancies. When they say whether they are properly dealt with means whether, say, for example, a free sample, so whether their accounting has been done, whether loss due to theft or natural calamity, whether a write-off entry has been passed on time, issues not recorded, whether, so all those things get regularized quickly. So that is what is important to note. Only if it is more than 10%. Here you have to remember discrepancies observed during physical verification only, not other discrepancies. And you have to ensure, even if a valid explanation is there, still you need to disclose if the differences are more than 10%. And there, to identify this 10%, you have to go on the basis of the class of inventories. And for class of inventories, you have to refer to the accounting standard. Normally, your raw materials, work in progress, finished goods, stores, packing materials, and so on. Now, this is a clause, one of the important clauses. Scope and coverage. See, now here, there is an enhanced reporting in the sense that whether a company has made, this is the umbrella clause. If during the year the company has made investments in or provided any guarantee or security or granted loans or advances in the nature of loans, secured or unsecured, to the following parties: to companies, firms, limited liability, partnerships, or other parties. So it is not only to companies, but to anybody. to firms, to limited liability partnerships, or to other parties, to anybody, if it has given any loans, then the subsequent 6 sub-clauses which we are discussing, clauses A to F, then it is applicable. Earlier, it was only loans to companies covered under Section 189 register and all that. Now, anytime any company has given you one loan, you need to ensure that reporting of certain matters is there. Now, this is a new clause. First of all, this is just a factual, simple disclosure. What is the aggregate amount of loans to subsidiaries, joint ventures, associates, and parties other than subsidiaries? So you need to just classify and compile this data. Aggregate amount of loans, advances, guarantee, or security, other than, of course, to company whose principal business is to give loans. So for an NBFC, for example, which is a loan company, loan classification credit company, they may not give, others have all to disclose. Transactions are not prejudicial. See, earlier, the requirement was whether loans and advances are prejudicial to the interest. Now, whether investments made, guarantees given, and security provided, and the conditions of loans and advances are not prejudicial to the interest. So now even all loans and advances, earlier it was only investments. So there is enhanced reporting. Now, loans and advances in the nature of loans, whether a schedule of payment is regular or stipulated. In all cases, we have to now cover. So whether the repayments are on time or not, whether they are regular, enhanced reporting for the servicing. So see, such a vast requirement is now there. The reporting boundary is enlarged substantially and significantly. Reporting and recovery of overdue amounts, whether reasonable steps are taken. Here, basically, loans and advances in the nature of loans. So even deemed loans, deemed advances, that is a major change. Even those. So that is one area where I will discuss in detail what could be deemed advances. This is another killer clause, evergreening of loans and advances. Whether the details for renewal or extension of fresh loans are granted to settle overdues of existing loans. So you are required to disclose specific details. So this is again a new clause. Demand loans. Whether any loans repayable on demand, specifying the terms or period of repayment in aggregate and to promoters and related parties, especially to demand loans, we find a lot are given to the promoters or to related parties. So you just have to report. There are specific formats for all of them which are there. So now clause-wise analysis, enhanced. As I said, the transactions scope has been enhanced to cover investments and guarantees, means for prejudicial reporting. Reporting is extended to all parties and not those covered under the register. Reporting is required only if transactions have been entered into during the year. Transactions not prejudicial, it has been enhanced to cover investments made. Earlier, it was only loans. Servicing of loans has been enhanced to cover advances in the nature of loans. So this is important to understand what are the changes. Now the practical challenges in reporting I have classified under 5 broad headings. See, first is under clause 3A, the aggregation of specified transactions. Then specified transactions and investments and loans which are not prejudicial. Servicing, evergreening, and demand loans. So these are the 6 clauses which are the main. Well, first of all, aggregation of specified transactions. It looks simple. But here you have to remember one thing, definition of subsidiary is under the Companies Act, which is different from the definition under Ind AS. So there may be differences between what you report under this clause and what is reported in the financial statements, especially for Ind AS companies. the definition here under 287 is the definition similar to AS 21, but it is different from the definition under Ind AS 110, which is much broader and also talks about de facto control. It talks about power to govern the financial and operating policies, not only necessarily control through shareholding or composition of the board of directors. So companies adopting Ind AS, there could be differences between what is disclosed in the accounts and what is required to be reported under this clause. That has to be reconciled. Very important. It looks simple, but these are the complications. Tracking of transactions entered into and settled during the year. See, you have to give the aggregate of specific transactions entered into during the year, even if the same are settled. So this may present challenges where the volume is significant. So you have to have proper design, MIS, controls, everything. There may be transactions which may have been squared off or settled, but these have to be also factored in. So it is not only the balance, but the volume of transactions which have happened during the year, aggregate transactions. Very important. Identifying advances in the nature of loans. This is a universal applicability against various clauses. This is by far the most far-reaching change. What is an advance in the nature of loans would depend upon facts and circumstances. So you have to not only scrutinize all the advances given, but also old outstanding advances where amounts are given to ensure that their propriety and reasonableness. So all old outstanding advances, even old outstanding supplier advances need to be now scrutinized for propriety to ensure that they are not really in the nature of a loan or a financing arrangement. See, certain guiding principles have to be mind. They may not be exhaustive. See, an advance against a purchase order in accordance with a normal trade practice would not be an advance in the nature of loan. An advance for an amount which is far in excess of the value of an order, or for a period which is far in excess of the period for which the advances are usually extended, may be in the nature of a loan to the extent of the advance. Where there is normally no trade practice, a useful guide would be to consider the period of time required by the supplier for execution of the order. Any advance which exceeds this period would normally be an advance in the nature of loan. Normally, if there is a stipulation of interest on an advance, it would give an indication that it is an advance in the nature of loan. However, it may not necessarily be so. So these are some of the factors which you need to keep in mind. Now, whether transactions are not prejudicial. Here also, auditors for investments especially have to evaluate the adherence to the processes and controls. Whenever an investment is first made, you need to consider the financial position. What is the purpose for making the investment? Its leverage, whether a valuation, whether it is at a fair value or a value far in excess. See, if a valuation is based on a third-party valuation report, then if it is the investee is a related party specifically controlled by the promoters, then you have to see whether it is prejudicial or not. See, normally advances to a wholly owned subsidiary, even if it is basically given, even if the subsidiary is not doing well, is normally not considered prejudicial. But other than that, any group companies, if you are keep on just pumping in money and then later on keep on making provision for impairments, then that is prejudicial to the company's interest. Now, many companies, as I said, infuse additional funds in their group companies, which are their strategic investments and which have financial difficulties. So such infusion would per se normally not be considered as prejudicial unless it is proved to be again like a Benami entry or just sham book entries. That you have to see. So these are some of the considerations for prejudicial or not. Now, NBFCs are also covered for reporting under this clause. Now, that is where there may be specific challenges because it is their business to undertake investments and loan transactions. So here, what is important is that there are guidelines which are issued by RBI. So whether the transactions are in accordance with the RBI guidelines, in accordance with the board-approved policy, and if there is any deviation from that, that would be a case where it is prejudicial. Otherwise, not. So here you have to reporting any specific significant transaction, any general non-compliance will also need to be. Suppose loans are in excess of certain limits or certain other things. So general non-compliances and even specific transaction-based non-compliances. So for NBFCs, you need to be extra careful. Salary and other advances normally, unless there is a material deviation from the laid down policy, are normally not considered as prejudicial. Servicing of loans. Here again, due to the reasons discussed, the auditors would have to use their judgment whether servicing is regular. Here, see, you have to indicate separately the names of the parties. Now, this is a lot of practical challenge, especially for NBFCs. So normally what can be done is that for NBFCs, you may agree anyway, you are required to give the details of non-performing assets and all that. So you may just aggregate the disclosures. Many times there may be some restructurings because of COVID. So there also you may have to disclose these. And then consolidate everything into various legal buckets for logical buckets. So it may not be possible for a housing finance company or a vehicle finance company to give the details of delays in repayment for each and every individual party. So this is where you will have to see and maybe compile the information in some logical form. Now, the guidance note has not really specified it, but that is a practical way out. Evergreening of loans. It is a very complex group structures which would be there. It would be very difficult to establish a clear audit trail. Now, what is the reporting requirement? What is the percentage of such loans where there is evergreening? So this clause requires reporting of percentage of such transactions into the aggregate value of loans and advances in the nature of loans. Now, what is a denominator? Denominator includes loans and advances in the nature of loan. So what is an advance in the nature of loan? Again, there may be challenges. So you have to reconcile the denominator, especially for advances in the nature of loans, with the financial statements to ensure completeness. Many times such evergreening may apply post-balance sheet. Now you have to consider the RBI guidelines regarding this restructuring and all that. When there is a reasonable, accordingly, borrower account should be taken up for restructuring by banks only if the financial viability is established. You should just not take up a restructuring and provide a new loan to enable him to settle the earlier loan. Restructuring should be because of genuine business reasons. So that is what needs to be ensured. Demand loans also, promoter definition is important, which we saw. Identification of subsidiaries also we saw earlier, especially for Ind-AS companies. NBFC's transactions. Now there are RBI guidelines on demand loans which need to be adhered to. If there is any deviation in those guidelines, what are those guidelines? That the board of directors have to frame a policy. The policy shall stipulate a cutoff date, servicing of interest at monthly or quarterly rests. It is important that even for a demand loan, at least though the cutoff date has to be specified, what is the interest repayment frequency? That is very important. Even you just cannot keep it entirely open. This is for NBFCs, but other than NBFCs, though technically there are no guidelines, it would be useful for companies to refer to these RBI guidelines for demand loans. And here again, the reporting requirement is the total of the demand loans against the overall total. So denominator determination, especially for advances in the nature of loans, could pose a challenge for the reasons discussed earlier. Now, CSR is a relatively simple thing. I won't waste much time. All of you are aware of the provisions of 135.5 and 135.6. So whether any ongoing. See here some of the practical challenges which are there. What is an ongoing project and what is not an ongoing project? Many times, see, what may happen is that the company may be running a project for a period of few years, and it will still continue to run for the next few years. So now in that case, when to really draw the line for ongoing projects? Many times I think companies may just take board approvals and try and keep on extending and all that. We have to be very careful. See, many times it may so happen is that the obligations last with the implementing agencies. So it's done, especially if it is done through a third party. So there could be practical challenges. Then multiple projects also, if there are there, maybe ongoing, whether a separate bank account, special account has to be maintained, not necessary. Now, capital assets acquisition in earlier periods, I think that cutoff was there. I think that is no longer relevant now because that was a first time thing. Transactions with related parties, especially companies which have their own foundations. So there has to be proper monitoring and impact assessment. Statutory auditors also I'll just touch upon because any issues, objections or concerns. See, you have to be just very briefly familiar with what are the guidelines. There are SEBI guidelines. There are guidelines under the Companies Act. There are guidelines under the Chartered Accountants Act. And there is also an implementation guide. See, all of these broadly cover the requirement that whenever an auditor resigns midway, not when he rotates out, but when he resigns midway, before the incoming auditor takes over, are there any genuine reasons? Are there any genuine reasons why they have moved out? And whether it is good for the incoming auditor, whether it is safe for the incoming auditor to step in, we need a lot of things in newspaper reports now. Firms resigning left, right, and center. So whether the requirements are complied with, whether because a modified report is issued, or whether there is, and the communication has to be specific. Oral discussions are now no longer permissible. Now we have to get written instructions. Now, have there been frequent resignations? Whether there have been delays in the payment of statutory dues, or whether the auditor had bandwidth challenges. In some companies, that is also the huge companies only by a proprietary firm with only 2 or 3 qualified assistants. So because of the bandwidth issues, so you have to ascertain the reasons. Financial statements, of course, naturally, where the going concern assumption, accounting policies, whether they are not proper, long-drawn litigation, or any other information which may be available in the public domain, you need to factor all this. Now, another important clause is deposits, loans, and borrowings. See, deemed deposits. See, this existing clause of acceptance of deposits was always there. Now, the only change is that deemed deposits are also included. So that is the enhanced reporting. Then default in the repayment of loans. Here again, challenge. Lender-wise details of given. Number of days delay. So any 1 day delay also you have to now report where the company has defaulted. Again, very sweeping. then whether the company is declared a willful defaulter, which is an entirely new clause. Whether the term loans have been applied for prescribed purposes. Short-term loans utilized for long-term purposes. This was there earlier. It was removed. It has again come. Then funds borrowed for meeting obligations of group companies. To fund your group companies, so you need to give the details. Loans raised against pledge of securities of group companies, against the pledge of securities. So mainly in this clause deposits, it is more of factual disclosures. It is not saying only if there is an adverse situation where you have borrowed for meeting obligation. They are not saying whether it is prejudicial. It may be good, it may be bad, but you have to still disclose all these details. So mainly deemed deposits under the Companies Act. I think you must be aware of the company's acceptance of deposit rules which are there. And those are where they are saying that some of the cases deemed deposits include all deposits except deposits from government, intercorporate deposits, and there is a whole list which is there under the company's acceptance of deposit rules. So those are, other than that, everything is a deemed deposit. You have to be aware of the RBI Master Circular on willful defaulters. Now here, you have to be just aware of what are the key trigger points for identification of willful defaulters. There should be diversion of funds or there could be siphoning of funds. So now what are the trigger points or points for diversion? Utilization of short-term funds for long-term purposes. So whether such things are it, deploying borrowed funds for creation of assets other than those for which the loans were sanctioned. You may take a loan for a project, but ultimately no project or asset has come up. Transferring borrowed funds to subsidiaries or group companies. So any such routing of funds through any bank other than the lender bank or members of the consortium. Investment in other companies by way of acquiring equity without approval of the lenders. You may not take the approval. Shortfall in the deployment of funds vis-a-vis the amounts disbursed. So these are all the trigger points for diversion. Siphoning of funds. If the funds borrowed from banks were utilized for purposes unrelated to the operations, to the detriment of the financial health. Again, there is a lot of judgment. Now, you may be aware that the willful defaulters, in terms of the RBI Master Circular, after the RBI has done a scrutiny, they put up the names of the willful defaulters on the RBI website. So mainly, of course, that information is available. Now, deemed deposits is being enhanced to cover amounts which are deemed to be deposit. Default in repayments of the loans to cover all borrowings. So even debentures, commercial paper, subordinated debt, and intercorporate deposits. Earlier, it was only term loans. Now all loans, all borrowings from any lender, and not just restricted to borrowings from financial institutions, banks, or dues to debenture holders. The scope of reporting has been extended to interest on the borrowings. So not only the repayment of principal, but even a one-day delay in interest you have to disclose. If there is a default in the repayment, the format has been now very clearly specified. So a lot of micro details. So practical challenges in reporting under these 4 broad heads. Here again, like for loans and advances, there are 6 sub-clauses. Inclusive nature of definition. Deemed deposits. Deposits which are technically not in the nature of deposits by virtue of definition, but substantially having are also required. Higher risk of non-compliance. Many times the auditor should obtain the list of amounts received in the course of for the purposes like security deposits and assess whether these amounts comply with the statutory requirement. For example, any advances outstanding for more than 365 days and there is no sales order. So those would become deemed deposits. So your internal controls and all need to be reviewed to ascertain the data, ascertain the correct compilation. Borrowing companies adopting Ind AS. Now, this is where there is a challenge. Borrowings need to be considered on the basis of the legal form rather than substance. So here, basically, your redeemable preference shares may be borrowings under Ind AS, but they are not borrowings under the legal form. Debentures, equity, convertible debentures may be equity, but they may be borrowings. Interest which is charged has to be computed on the basis of the EIR method. However, for identifying unpaid interest, only the contractual interest has to be considered. Now, Ind AS 107 requires maturity analysis of disclosures under different liquidity buckets. So this information you should use to cross-check whether the disclosures have been under Schedule 3 also for the overdue balances and all that. So these are some of the, for companies adopting Ind AS, you need to keep these specific factors in mind. Rescheduled proposals. If a company has submitted an application for reschedulement to the lenders, the same would also be considered as a default. It's been approved during the year, the auditor should state. The guidance note has clarified that where a repayment of loan has been approved subsequent, that also a remark should be mentioned. So even if a post-balance sheet event also, you need to disclose. Challenges for NBFCs and other highly leveraged companies. Here again, practically it will be difficult to verify individual cases, but we have to still see. Here you have to rely on the controls, because otherwise each individual case, you have to also obtain the latest credit rating report and see whether there is any mention of any default. A decline in the credit rating would normally trigger an element of professional skepticism about whether there is a default or not. So that is when then you have to be alert. Now, in respect of NBFCs, this is important. NBFCs which have issued subordinated debt and perpetual instruments in terms of the RBI guidelines. There may be no repayment, but there may be certain events or triggers which may happen because of which the repayment may have to be done. Especially of the principal amounts where the same have not been complied with. Because subordinated debt is normally not redeemable at the instance of the holder or without the consent of the supervisory authority. So if RBI has issued any order, then that it acts as a trigger point, and if that has not been adhered to, you need to report. Now, a non-deposit taking NBFC with an asset size of 500 crores can issue a perpetual debt instrument. However, this may issue it with a call option for a minimum period of 10 years, and the call option should be exercised only with the prior approval of the RBI. So for such instruments also, if it is there, you need to see whether any repayment triggers are getting affected or not. So you need to be aware of the RBI guidelines. Willful defaulter. See, a company may not have been declared a willful defaulter, but as I said, the process of declaring a willful defaulter takes time. The RBI may start issuing a show cause notice, then obtain an explanation, and then they may disclose finally after a gap. So if this process is on, you may consider disclosing the fact. In case the show cause notice is not received, the auditor should obtain a representation that the company has neither been declared nor has received any show cause notice. And this would normally happen when there is a default or when there is a fall in the credit rating and all that. That is when he would have to ask specific questions based on his reporting under clause A earlier. Many times there may be disputes also which may happen. The company may legally dispute. So then you have to perform the procedures under SA 501. Review the management's assessment, whether any legal counsel has provided the opinion, whether any other such things are there, and if there is an element of doubt, make a factual disclosure. That way the process is going on and we cannot comment whether a company is a willful defaulter or not. So this is where also some of the factors needs to be considered. So you just don't only stick to just referring to the website. You have to go beyond that also. Post balance sheet event also you may have to factor in. So these are the points which have to be there. See, you have to see whether there are any trigger points. The first trigger point is whether there is a default, whether there is a decline in the credit rating, whether they are not servicing their borrowings. And then all these would trigger a lot of other things. Application of term loans, transactions of promoters and related parties for these in-AS entities, there may be compound financial instruments. So in such cases, the entire proceeds, not only the portion which is debt, compound financial instruments, if it is legally a borrowing, you have to take the full and not only the portion which is shown as debt. Application of term loans, you have to refer to the RBI circular on willful defaulters, not used for prescribed purposes. See, these are payment of capital goods vendors from CC limits, meeting companies' margin money from CC limits, investment in subsidiary or group companies, investment in capital market, purchase of immovable properties for personal use of promoters or KMPs. Current ratio less than 1 may indicate that the company has diverted working capital loan. So these are all some of the indicators which you may factor in. Many times direct linkages may not be possible. See, this was the requirement earlier also when this clause was there. We used to do it on the basis of the overall balance sheet of the company. And if the quantum of long-term funds is less than the funds used for long-term assets, this may imply that some of the long-term assets have been financed through short-term funds. This was there earlier also. So overall deployment you need to see. See, many times, many companies take these public deposits. There may be a maturity mismatch. But if there is a history of renewal, then at least it can be considered that we may be able to demonstrate if the bulk of the deposits are renewed, then there may not be a mismatch. So then we can say short-term funds utilized for long-term purposes. See, for ALM, for Ind-AS and NBFCs, you have the ALM and maturity analysis. So that needs to be referred to and cross-tallied. Funds borrowed for meeting group company obligations. See, these are all these identification of subsidiaries based on legal control only. So those we have already discussed. I think for lending, so similar things which we have discussed also for borrowing. Reporting boundaries. Group companies, again, it covers all types of borrowings. Guidance note has specified that the word entity would include banks, financial institutions, LLPs, and trusts. So here everything has to be taken. All sorts of borrowings, even from proprietary concerns and from individual parties and all that. So sometimes to get a proper audit trail may be a challenge. Now, funds borrowed for meeting group companies' obligations. Now, when you say term funds, guidance notes has clarified that include both short-term and long-term, and it would cover share capital also. So if there is a share capital, which is company has issued shares during the year, you should refer to the offer letter to identify if the funds are utilized for granting loans and advances or for meeting obligations of group companies. So all this you have to keep in mind. See, challenges for NBFCs and all that, highly leveraged companies, we have already discussed earlier. Identifying subsidiaries and group companies, then there may be sometimes a negative lien or a floating charge. So whether reporting under this clause only when they are held a pledge. So where there is a negative lien or a floating charge, these are not to be considered, which are raised against pledge. So negative DN is not to be considered. See, validity or legality of a pledge, there are some requirements which you need to keep in mind. So I'm just not going through that. You can refer to that. The fraud also, there are some enhanced requirements. It has been widened to cover officers or employees. Earlier, it was only officers or employees, now all frauds. So you have to be aware of the whistleblower mechanism, undisclosed income under Income Tax Act, and the Vivad Se Vishwas scheme. See, conflict with responsibilities under SA 240. This is very important. SA 240 says that frauds are only those which are financial statement frauds. So this is in conflict with the CARO requirements, where it says that any fraud noticed or reported. So accordingly, you are required to report not only the frauds noted or detected pursuant to 140, but also those which are reported under 143.12, and also those detected by the management. So any frauds reported by the internal auditor through a whistleblower mechanism or through an audit committee also have to be all reported. Concept of materiality. Here again, it appears that it needs to be reported irrespective of the materiality. Though the guidance note, of course, specifies that the order applies to material items. So here, that is where there is an inherent conflict. FRRB and QRB have been coming down harshly because in their review reports, they are not favorably inclined to the concept of taking shelter under the garb of materiality for reporting under this clause. So there may be challenges in detection, acts by employees or others that have an intent to injure the efforts. See, many times employees may receive payoffs from vendors. Now, how do you prove that? Or they may tamper with the QR codes during the billing or collection process. Very difficult to identify. So here they have to use a lot of judgment, robustness of the internal controls, code of conducts, ethics policies. See, now companies, even under ESG, they have the governance standards, anti-corruption and bribery policy, code of conduct, whistleblower mechanism. There are a whole lot of things which all need to be kept in mind. Now, if there is a fraud by the predecessor auditor, it is technically a fraud during the year because an auditor may be appointed during the AGM, but prior to that, during the year, if an earlier auditor has determined the fraud, then you have to also consider reporting that at the end of the year. So this is also one twist which is there, which you need to keep in mind. So your incoming auditor should seek a specific clarification from the predecessor auditor and also obtain a management representation. Post-balance sheet events also you need to factor in, that is common. Monetarily immaterial frauds below 1 crore have to be reported to the audit committee. Though there is no specific reporting responsibility under 143.12, this also frauds need to be reported under that 143.12. That frauds below 1 crore have also been reported. So that is also another thing. Cost audit and secretarial audit, if they have also identified any frauds, those need to be also reported with a factual clarification, because those are also covered under 143.12. Whistleblower complaints is very dangerous. Sometimes anonymous complaints, you have to take it with a pinch of salt. Greater degree of professional skepticism. Or you should rely on information in the public domain or corroborate it based on your understanding of the business or any other specific factors or transactions. Companies which are not covered under regulatory framework, especially the non-listed entities, whether they really have a proper whistleblower mechanism. See, the best thing in such situations is there has to be a dedicated email ID which has to be there. That has to be announced. And employees, you need to look at that. There is no other way in which you can really identify any whistleblower complaints. If there are some forensic investigations in progress, if a forensic auditor is appointed, so that may also be an indicator. Outsourcing arrangements. Many times, all these things, there may be independent direct confirmation from whistleblower, they may be managed by a third party. Some companies may have that, so you need to keep that in mind. Now, unrecorded transactions means that the company must have voluntarily admitted to the addition of such income. Now, that is also required to be disclosed under Schedule 3. Now, here, what constitutes voluntary admission? It's very difficult because there may be a lot of pending tax assessments which have been decided up to a particular stage and the company chooses not to file an appeal. So what do you do? In my view, the safer option is to consider these as voluntary admission. So these are some of the factors. Now, Vivad Se Vishwas scheme, it may not be relevant now, so I think let us skip it. Now, NBFCs also, there are specific challenges which are there. Relevant statutory, you need to know what is the definition of an NBFC and what is the business of financing. See, here only one thing I would like to draw your attention, that there are certain companies which are non-banking finance companies, but they are not required to obtain registration with the RBI. So these are merchant banking companies, broking companies, and chit fund media and all. But such companies also are engaged in the business of non-banking finance. So we may need to report that these are companies, but they are not required to obtain RBI registration. Principal business is that 50-50 test, which all of you are aware. Housing finance activities, housing finance companies are also now covered under RBI. Earlier, they were under NHB. Now, here there are a whole lot of these guidelines which you need to be aware. What is more important is that if an NBFC has not complied with any of the guidelines, it is ideally necessary for you to report whether the conditions have been complied with or not. So these are all, I am not going through these. These are all the conditions which NBFCs need to comply with. Different categories of NBFCs. I have just put it so that they are available for reference. These are the definitions of group companies and all that. Definition of net assets. So NBFCs, most of the overriding thing here is that you need to be familiar with the regulatory guidelines and whether those have been complied with or not. See, entities engaged in other than NBFI activities. See, many times it may so happen that by default, a company's financial assets and financial income exceeds more than 50% due to business or commercial reasons. Does it become an NBFC? The answer depends upon facts and circumstances. You need to look at the memorandum of association, the objects and all that, and see whether they have made an application or a correspondence to RBI seeking condonation. So you have to use your judgment. As I said, NBFCs not requiring registration, you need to disclose. See, many times the auditor should check whether a certificate of registration is still valid or not. Otherwise, you may have to report. There are auditors reporting responsibilities also in terms of the guidelines. So you have to keep those in mind. Identifying subsidiaries and associates is a common requirement which we have disclosed, especially for Ind AS companies. The conflict between the legal and the Ind AS definitions. That is all same. Then this compound financial instruments and all that, hybrid instruments. Now, reporting on financial position. See, here it also talks about that you have to be aware of what is the definition of financial assets and liabilities. For Ind AS companies, it is not an issue. But for other companies also, you need to look at the definition of financial assets and financial liabilities as per the Ind AS. cash losses, it was a requirement which was there earlier. And then this clause here, financial position, including financial ratios, all of you would have seen auditors' reports with the standard clause. Whether based on the expected dates of realization, whether the management has been able to satisfy debts due within the next 12 months. So essentially, it involves an ALM analysis. So definition of financial assets and financial liabilities you need to look at. Now, no clarity on the definition of a term cash loss. There is no definition of a cash loss in any accounting standards or companies, and the only place where you can find is in some guidance note on terms issued in 1983, cash profit. And that also is a very simple definition. Net profit has increased by non-cash costs such as depreciation and amortization. When the computation is negative, it is termed a cash loss. So it is an inclusive definition. Now, when Ind AS के जमाने में you have deferred tax, unrealized gains, fair value adjustments, actuarial gains, all these are also technically not to be considered. These are basically non-cash items. So where the cash losses then has to be taken. For companies adopting Ind AS through OCI, you may be adjusting certain entries. So there also you have to be careful what you consider as cash loss or not. Then because of the Ind AS 8 prior period errors of the earlier period, that also the effect of those has to be also taken while determining the cash loss. Now, financial position. Now, this is the last main point. See, what are the data points on which you need to rely? You need to rely on the financial ratios, aging and expected dates of realization of financial assets and repayment of financial liabilities. Then your directors report MDA and the auditor's knowledge of plans of the board of directors. So the auditor is expected to act like the soothsayer. He should be able to read the minds of the management and the board of directors. So here there may be certain specific challenges for non-NBFCs and MSMEs. The NBFCs is not a problem because NBFCs are required to give under RBI guidelines the ALM report. So first of all, financial liabilities, you go on the basis of legal forms we have already discussed rather than substance. NBFCs, non-NBFCs may not have a formalized ALM system. So here it is encouraged that they should follow an ALM system now to enable getting reports under this clause. MSME entities also similar requirements are there. So auditors of such entities would need to take greater care. Significant judgments. See, financial ratios, there is no standardized definition. Different companies can use different definitions. They operate under different conditions, so these have to be all factored in. Then, Schedule 3 definition, while calculating ratios, current and non-current classification also sometimes may be an issue. What is a non-current asset and a current asset sometimes involves judgment. For example, leave encashment liability. We take a view that it is a current asset, but all companies, they go on the basis of the actuarial. Expected date of realization. There also, again, for non-NBFCs, it is a challenge. So here, and even documents in the MD&A annual report and all, SA 720 also comes into the picture. Now, how do you review the board of directors and management's plans? Compare it with peer group or industries. There are a lot of challenges in all this. So here you need to have robust audit documentation. Okay. So I'm sorry I've taken 10 minutes extra, but I tried to cover it in as comprehensive a manner as possible. All of you can go through the presentation in a little bit more detail. I have just tried to cover the gist of it because I've tried my best. I think we can take some questions.
Yeah.
Sure, sir. I'll just. So first is, if consolidated financial statements are not filed with ROC, what is the duty of auditor under the Companies Act, auditor's report?
Consolidated are not filed.
Yeah.
This is, of course, I mean, not filed with the ROC. Is he done the audit? See, this is not a question related to this topic, please. So I would not like to answer that.
Sure.
Has the consolidated, or this has nothing to do with Schedule 3 and CARO. Please ask questions only on the topic and not to clear your queries, please.
Sure. Disclosure is to be given only when the company is benamidar or even when the company makes payment for any property.
No, only when the company is a benamidar.
Okay.
So definitely, if you make a payment for the property, then you become a benamidar for a benami property. Yes, you become a benamidar only.
Yeah. Next, if non-deposit accepting non-systemically NBFC trading in shares on recognized stock exchange, in such a case, shares held on closing date, whether it would be covered by AS2, if it's not, then how diminution is to be recognized, each script-wise or on a group basis.
Yeah, I mean, okay, this is also an accounting question.
Yeah.
But here I think also it is to be, you are dealing and trading in shares, so it is an inventory. So if it is an inventory, you have to follow, it has to be script-wise only according to me.
So next is relation to CARO, very relevant and common question.
Yes.
It's in relation to NBFC registration requirement under 45A.
Yes.
Many times practical issue faced wherein due to fair value of financial instruments, mainly quoted investment, 50-50 test is crossed by the company. In such a case, whether reporting
Yes.
under this clause is required.
No, I know. Yeah, no, that is a good question.
Yeah.
See now, if it is a non-finance company, right?
Yes.
Yes. No, so I mean, according to me, it will not be triggered. You have to, I think, what is the main business of the company? You need to look at its objects. And if it is just some temporary blip, then you may have to just write to the RBI. My suggestion is, in such a case, you make a factual disclosure, and the company also should be advised to just make a representation to the RBI that this is what is there, and our business is not really in dealing with shares on in an NBFC business. Our business is so and so. And that is it. And especially if you are able to demonstrate. Or the other alternative is that, I mean, you have to be able to see that, except for the fair valuation, the actual carrying cost or the transaction cost really is below the 50-50 limit. See, I have come across a case where a shipping company which I used to audit, they had sold off all their ships. Only one ship was remaining. So they had to deploy all the funds in financial assets, pending further business plans and all that. So there also the 50-50 test was breached. Now this was well before all this CARO reporting and all was there, but the matter was discussed at the board meeting. And then we took a call. At that time, I don't think there was a reporting requirement which was there. But many times practically these things happen. Yes. Anything?
Continuing to that question, financial assets and financial income is not defined in the RBI.
Yes.
So in this case, whether meaning can be imported from Indes.
See, it is, that is what I have said. In fact, that is what I have indicated. And see, financial assets, there is only an RBI clarificatory circular which states that bank deposits are not considered as financial assets.
Yeah.
Bank deposits are not considered as financial assets. See, because here also I have practically faced a situation where a company, basically, which had become a subsidiary, it was taken by a company and became a subsidiary of an NBFC. And pending their business plans, they had a significant amount of their money kept in bank deposits. So there the RBI sent a letter to me as the auditor that the 50-50 test is not complied with because bank deposits are not financial assets. So then I wrote a question that bank deposits is a financial asset because it is ultimately going to be realized in cash. It is a financial asset as per the definition. That time there was no Ind AS, but still I have used that definition. So they said that RBI has not clarified. So after that, I think sometime after the 6 months after that, I think RBI came out with a clarification that bank deposits are not to be considered as financial assets for the 50-50 test.
Okay.
But otherwise, you have to go as per the Ind AS definition only. But exclude the bank deposits. Because it is mainly, you should have investments in mutual funds and all other shares and all the other. It should be investment avenues. You may have intercorporate deposits, but not bank deposits. Now you take a situation where companies which have investments in HDFC FDs, corporate deposits, now that will become bank. There may face a problem. Yeah.
Yes, sir. So next is, in case of sanction limit, if there is no sanction limit during the respective year for which reporting is done, but there is a continuing sanction limit of previous years.
Yeah,
So
continuously. Yeah. Continuously, because you have to, the sanction limit is still valid. And because of the sanction limit, I think you have to still keep on filing the documents.
But the reporting under the CARO saying if there is any sanction during the year, then will it be triggered? That's the question, sir.
No, but sanction during the year for the first time, but if it is continuing, also it continuously, because UFC, the idea is to basically see whether you are filing your stock statements and all on time. So it is still subsisting.
Correct.
Just in, yeah, you can't, the idea is not that in the first year you do it and then in the next few years, I mean, till the time the borrowing is pending, I mean, you have to continue reporting. The idea is sanction during the year, but if there is no disbursement during the year, you still have to report.
Yes. So next is a common thing. So if any installment of term loan are paid through the CC account, whether it can be considered as application of short-term fund for long-term purposes.
The installment of term loan for, installment of term loan paid through the
paid from CC account from short-term borrowings. It can be considered as application of short-term fund for long-term purposes.
It can be, yes, but then that doesn't prejudicially affect. How does that impact? It can be considered, yes, but you may make a factual reference. See, here for short term and long term, the guidance note is very clear. You go on the basis of an overall assessment. This was there earlier also. This reporting requirement was there in an earlier version of CARO, then it was deleted and it has again come back. So you have to go on the basis of an overall assessment of the balance sheet. That stand the institute hasn't changed. So this is only academic. This is only here you'll have to see whether there is any misutilization of funds and all. From that angle, there may be an issue. But I don't foresee any problem. Yeah.
In case where subsidiary has been granted interest-free loan, but has to account for interest as per Ind AS 109.
That is okay. You go as per legal form.
Okay.
Legally, you are not required to pay interest. Here it is legal. That is very important everywhere. See, that is where a lot of these slides have been repeated. Yeah.
Sir, one question in relation to CSR. Directly related. I'll keep it on you, sir, if you want to take it.
So, which one?
In case of CSR, on ongoing project run by third party, and if the company contributes to that party, then will it be an ongoing project for us also?
Yeah, we have it is part of our obligation. So it is an ongoing project for us. It is an ongoing, and that is what I have covered in the slides also. That we have to, I think we have to get the reports from the implementing agency and all that, the utilization and all that. Yes, it is primarily our responsibility. Yeah.
Yes, sir. By this, we have completed all the questions.
Okay, very
That is
good.
why you can.
Yes. Okay.
Yeah, I think thanks to all participants for patient hearing, and I think Zubin sir's presentation will definitely serve as a guide for our reporting matters, and I think it would be a very useful, and I think it would be posted on the CTC website where everyone will be able to download it later. And thanks, Zubin sir, for your time. I would request Yogesh bhai to propose a vote of thanks.
Hear you.
Yogesh, bhai, we can't hear you.
Still can't hear you.
I think Deepak, you can take it up.
Yeah. Okay. So definitely with huge data which you have put in your slides definitely requires great time and effort, which we really appreciate and which all the participants are also going to get. So we have covered the topic very beautifully at length. And for that, on behalf of Chambers, all the participants and all the members of Chambers, we extend a very warm vote of thanks to you. Thank you very much, sir. Thanks for sparing the time.
Thank you. My pleasure. Thank you very much.
It's always pleasure listening to you, sir.
Yes, yes. No, I've tried to do as much justice. I said that the important thing is to put all the points so that even if everything can be covered in detail, at least it is available for reference. That is what is my idea.
Yeah.
Yes, sir.
Yes.
Thank you, sir. Thank
So
you.
you can put it up on the website, but will it be accessible only through to members, or it should not be accessible to everybody because only the members should get the benefit?
Yeah. Members, we will circulate even on the this.
Registered mails.
I think better. I mean, you can definitely keep it on the website, but with proper control. I mean, so that it should. I mean, members definitely should get the benefit, or all the participants who have joined today should be emailed to them. So the non-members amongst those also.
Yes.
And maybe it should be in a non-editable version. So if it's possible to convert it into a PDF.
Yes, sir.
Okay. Thank you.
Thank you. Thank you, sir.
Thank you, sir.
Thank you. Thank you very much. Thank you.